Advanced Financial Accounting PowerPoint presentation. In this presentation, we will take a look at interim financial reporting rules. Get ready to account with Advanced Financial Accounting. Interim financial reporting rules. Starting off with interim reports. So interim reports, they will cover a time period of less than a single year. So when we're thinking about the interim reports, when we're thinking about interim information, we have the year-end information. When we think about financial statements, we often, what pops into most people's head most of the time, are going to be for the year-ended financial statements. Income statement covering January through December, balance sheet covering the year-end if it's a fiscal year calendar year-end. Interim, then, we're going to be talking about the financial statements at some interim period, typically quarterly meaning first, second, third quarter, and then you got the yearly information for the fourth quarter. Therefore, the interim reports, they will cover a time period of less than a single year. The goal is to provide timely information about the company's operations throughout the year. So obviously, more information is nice. We want timely information for the decision makers. We got the year-end reports. It would be nice if we had the quarterly reports, which we have now, to give us more timely information as the year goes by. Quarterly reports are required to be published for publicly held companies. So if you're a publicly held company, the stock is being traded on stock exchanges and whatnot, then people need current information. The market needs current information. Therefore, it's a requirement to have the quarterly reporting for that timely information. The quarterly reports can generally be thought of as smaller versions of the annual report. So when we think about the annual reporting, what's going to be included in it, the quarterly reports is, as you would kind of expect, right, a smaller version of that as we're doing the reporting for a time frame that's going to be less than the entire year. Here's some type of interim reporting requirements. Form 10Q, SEC's quarterly report. So this is the standard SEC's quarterly report, typically for publicly traded companies. Generally must file a 10Q within 40 days after the end of each of the first 3 quarters. So this will happen at the end of the quarters, so January, February, March. At the end of March, 40 days after the end of March, you're going to expect to see the Form 10Q, and then April, May, June, at the 40 days after June, you would expect to see another. July, August, September, at the end of September, and then October, November, December. Why not there? Because that's the end of the year. So you would expect to see the full thing at the end of the year in terms of the year-end reporting. The requirement is related to publicly owned companies. So we're talking about, once again, companies that are trading on the stock exchange. That's typically when the SEC is going to be influencing companies because they're regulating the trading that's happening on publicly traded companies. And that means that if you're trading to the public, that you have some necessities for the benefit of being able to do that, to be a publicly traded company and have that benefit, then you got to have some more requirements, which is going to be including these items here. So an audit is not required for the quarterly financial statements. So if you're talking about publicly traded companies, generally, if you're talking about the yearly financial statements, audits required. Audits are very time and cost a lot and time intensive, right? So the quarterly reports typically don't have the audit for the quarterly reports, and then you're going to have the audit for generally the annual reports. Items generally found in the quarterly financial reports include income statement for the most recent quarter and a comparative income statement for the same quarter in the prior year, in the prior fiscal year. So you got the income statement for this quarter and then the corresponding income statement for the same time period prior year. Income statement for the cumulative year-to-date period and for the corresponding period for the prior fiscal year. So say you're talking about quarter 2, Q2, gets a little bit complicated because then you're saying, all right, I want the 3 months income statement, the 3-month ended income statement for the current quarter, because that's what we're talking about. And we want to compare that to the 3 months of last year for the same quarter, Q2. However, we also have the information that has happened up until this point in time, meaning January through June. So the whole, first and second quarter could be included on the income statement. And we would want that too. So we would want the full cumulative year-to-date, January and February, if it's at the end of Q2 for this year, and the comparative for the prior year. A condensed balance sheet at the end of the current quarter, as well as a condensed balance sheet at the end of the prior fiscal year. So notice here we're talking about the balance sheet, which is a point in time. So and it's a little bit easier in some ways because now we just need the balance sheet as of the end of the time period. So if it's quarter 2, it's quarter 2. We don't need to combine it to quarter 1 or anything like that because The balance sheet is, as of a point in time. We're going to look at the last time period. We're not going to go back to the balance sheet for like last year, quarter two. We're going to go to the balance sheet, the last balance sheet for the last fiscal year, typically as well, to show that. Statement of cash flows as of the end of the current cumulative year-to-date period and for the same time period for the prior year on the statement of cash flows. Remember, the statement of cash flows is going to be a timing statement as well, not a point in time, but a timing statement. Footnotes that update those from the last annual report. So we want the footnotes for any updates that are going to be necessary since the last annual report. Management report that analyzes and discusses the results for the last interim period. Pronouncements and interim reporting. We have the ASC 270 standardizes the preparation and reporting of interim income statements. So there's some standardization within ASC 270. You can check that out for more detail within it. ASC 740 discusses the issue of measuring the tax provision for interim reports when the tax expense is based on the annual income. We'll have a couple practice problems on this so you can get an idea of what is happening here. It's a problem, of course, because when you're talking about taxes, the taxes have a progressive tax rate, so the tax rate, can generally go up, and it's going to be applied to the yearly income. And so and it's based on taxable income as opposed to the financial income, and it has credits that are involved that's going to make it a little bit more difficult in just the calculation of the taxes. So how are we going to go through the task of taking the annual tax calculation and doing it on a quarterly basis? And so that we're going to have to some questions to that. So we'll think about how to go through that process. I recommend taking a look at some example problems just to get an idea of how that process works in your mind. International Financial Reporting Standards for interim reporting. This is the International IAS 34. Outlines the minimum content for an interim financial report. Similar to U.S. Generally Accepted Accounting Principles, so we got the U.S. Generally Accepted Accounting Principles and the International Financial Reporting Standards interim reporting. They're going to be similar. Remember that the goal for a lot of people, of course, is to try to get these two things on the same basis so that you don't have these different reporting for different areas if you're working in different exchanges and whatnot. And they've worked somewhat towards that, so they should be in alignment for many places, but sometimes they're not always in alignment, so it is what it is at this point. In any case, expresses that more estimates can be used in determining interim amounts than for measurement of the annual financial information. So in other words, if you're doing the quarterly reports, you're going to probably be using more estimates as you do so than you would if you did the annual financial reporting. Materiality tests will be made based on the relation to the interim period information, not on estimated annual information. And then the year-to-date disclosures are required in addition to specific interim period disclosures. Revenue. The same measurement basis used for the full fiscal year will be used to determine revenue for the interim period. So we want consistency with the basis on which revenue would be measured, which is a standard accounting principle, which you would expect. Revenue needs to be recognized and reported in the period it is earned. It cannot be deferred in order to show a more stable revenue stream, which again is what you would typically expect, right? From a corporate standpoint, what they like to see is a nice even upslope of revenue. That's what they have pressure to show for stock trading and whatnot. But clearly, what you want from an honest reporting standpoint would be that you're going to recognize the revenue on an accrual basis when it is earned, and that's going to be a revenue recognition principle that needs to hold there. So seasonable business revenue cannot be adjusted to eliminate seasonal trends. So seasonal businesses often have spikes in their revenue due to the season that they are in. And they don't really like those spikes. They would like to show it as a nice even trend upwards. But you can't do that because that's dishonest. It's not right, right? That's not how it happened. That's not how it happened in terms of revenue recognition. So you can't smooth out. You shouldn't be able to smooth out the seasonal trend. The point of the quarterly reports is to see what is actually happening. So you want a consistency with the revenue reporting. Inventory and cost of goods sold. In general, the interim cost of goods sold needs to be computed with the direct and allocated cost components on the same basis as used to compute the annual cost of goods sold. So once again, we have that concept of consistency, which of course we would expect to see and desire. Permitted modifications to the general rule. So here's going to be kind of some exceptions, modifications to the general rule. Can use estimated gross profit rates, lower of cost or market valuations, and standard cost systems. And then we have other expenses and costs. Other expenses and costs in general, expenses and costs will be charged to the interim income in the interim period they are incurred. That's the matching principle or the expense recognition principle, and that's an accrual principle, so you would think that that would hold as well. That should be a consistent principle. However, some expenses and costs will be allocated among the interim periods based on estimate of time used. So we might have some estimates that need to be used to see when they're going to be used. Estimate of the benefit received and activity level of the interim report. So we're trying to do our best to recognize on an accrual basis, basically, with the expenses in the proper period when they were incurred in accordance with the matching principle or expense recognition principle. Taxes in interim period. Estimating the effect of annual tax rate. So here's our problem. This is one of the bigger a big problem, is that how do we calculate the tax rate on interim taxes when the tax rate is based on annual taxable income, and it has differences between the tax and the book, and it has credits that are going to be involved and whatnot. So what are we going to do on that? Estimated the effective annual tax rate. We need to find the effective annual tax rate so we can use it to compute the interim income tax provision. So we need to figure out the provision for taxes in the current time period using some kind of effective annual tax rate. The estimated annual tax rate will include anticipated tax credits, state income taxes, foreign income taxes, capital gains taxes, and other tax planning expected for the entire fiscal year. The estimate will be updated each interim period, and the interim tax provision or benefit will be determined. We will have some problems with relation to this. I recommend going through the problems so you get an idea of this. But the general idea is you're saying, okay, if you have the tax rate for the entire year, first you got to kind of determine the tax rate, which could change based on your income level possibly. And then you got to figure out, we want all of income taxes. So we want to take all of the income taxes, which includes state and federal, possibly income taxes that we may owe. And then we would like to come up with one effective rate that we can use to apply to basically the quarterly's net income, as opposed to having to pull out on a quarterly basis, tax and book differences, and having to deal with credits being done differently or at the end of the equation. So we want to come up with a rate then that includes those things all in one rate, basically, so that we can apply that one rate to figure out the tax for the current quarter or the interim time period. Now, we're also going to have to do that quarterly, and the rates will change based on our differences in estimates. So we'll have to take into consideration, for example, in quarter 2, what happened in quarter 1? What were the estimates that were made for taxes in quarter 1 as we consider the effect on the current financials? All right, differences between book and tax income. We have permanent differences, and we have the temporary differences. The permanent differences will not be included when determining the amount of taxable income for a period, because we're going to basically reverse them out. So permanent differences are, things that are permanently not included in the taxable income. Maybe they're on books income, but they're not on taxable income. Or if we're talking about permanent expenses that are on the books that aren't included in taxes, those would be, they are what they are. Then the temporary differences would result in deferred taxes. These are things that are going to reverse themselves out over time. Differences in estimating methods, such as the depreciation method differentiating between books and taxes. Permanent differences examples. So here are some examples of permanent differences. Certain fines or penalties that are not tax deductible. So if something is on the books, there's a fine or penalty, it's part of a business expense, might be deductible for business purposes, but may not be deductible for taxes. It's not going to change. That's not going to reverse out. So it's going to be a permanent difference. We could have proceeds of life insurance collected that are not taxable. So we might have certain types of life insurance that is not taxable. We might have collected on certain types of life insurance. In other words, we might have income on the book side of things, but for taxes, maybe it's not going to be something that would be included in income. Life insurance premiums paid by the company on executive policies where the company is the beneficiary are not tax deductible. So we might have life insurance where we put money, the company puts money into the policy, and it's deductible possibly for books, but maybe it's not deductible for taxes. Again, not going to reverse out, therefore permanent. Interest income or state or local government bonds that are not taxable. So we might have income, like interest income from bonds or something like that, that's going to be on the book side of things, included in income, but not in revenue for the tax side of things because it's not taxable. Those are things that are not going to reverse out, therefore permanent. Temporary differences example. So here are some examples of temporary differences. Differences of the depreciation expense is probably one of the most common differences. So if we're using tax depreciation, you got to use exactly what the tax code says. There might be some different kind of acceleration methods that can be used, 179 deduction or some, other depreciation methods that might be implemented on the tax code, and on the books you might be using some other method such as a straight line method or something like that. And that means that the depreciation will be the same over the same time frame. Depreciation will be expensed over the life or the useful life of the asset. The cost of the asset is going to be applied out. However, the times that are being applied to will differ, and therefore you'll have these temporary differences which will wash out in the long run, but you're going to have the temporary differences going forward. Estimated expenses and losses that are reported on books when accrued, but on taxes when paid. So you might have some expenses or losses on the books that we said, hey, we accrued it to be there in accordance with the accrual principle, the matching principle, the expense recognition principle. But the IRS is saying, hey, that particular thing, you can't deduct it until you actually pay it, because you could see why the IRS would be a little skeptical on some things. So they might, want to see a cash payment for certain things. Well, that's going to be just a timing difference, because it's just a timing difference as to when we record the expense, when we think the accrual should be on there, or when the actual amount was paid. So rent collected in advance reported on tax return in period collected, and on books in the period earned. So on the revenue side, for example, we might be collecting rent for like a year in advance or something like that. And it might be a situation where we, from an accrual standpoint, wouldn't be recording the revenue because the person hasn't lived in the place for that entire year. We got the rent before. But for tax purposes, the tax code they want to record it when you get the money in that case. So they're going to deviate, the tax code deviates possibly in that case, because they're going to say you got the money, you have the ability to pay at that point, maybe whatever justification they have. Then you would then have to pay it at that point. But again, over the life of the year, it should wash itself out, because on an accrual basis, the revenue will be recognized over the point in time that it has been incurred. And on the cash basis, it would have been, if you got the revenue in advance, it would have already been recorded at the front end. So it's just a timing difference.